Welcome to the Security Economics Podcast. I'm Peter Harrell. I know that there continues to be a lot of tariff news, and we'll be sure to cover those developments in a future episode. This week, however, I wanted to talk about an under-the-radar idea that I expect will pick up steam in the coming weeks. The idea that the United States should establish a sovereign wealth fund to make strategic investments on behalf of the United States and the American people. President Trump has directed the Treasury Department to come up with models for a sovereign wealth fund, looking at other countries that have them, like Kuwait, Norway, and Singapore. And Trump has mused about the U.S. sovereign wealth fund doing everything from holding a stake in TikTok, the Chinese-owned social media app, to helping to rebuild U.S. manufacturing. The Treasury Department is due to finalize a report on this topic by early May, and I expect that there will be a lot of debate coming out of that report on whether and how the U.S. might set one up. I'm thrilled to be joined this week by Daleep Singh, who served 2 different stints at the White House as Deputy National Security Advisor for International Economics. During his second stint, at the end of the Biden administration, Daleep gave a lot of thought to whether and how the U.S. might set up a sovereign wealth fund, and he has some advice for the Trump team and for Congress as they consider this issue in the weeks and months ahead. Daleep will soon be joining PGIM Fixed Income, the global asset manager, as vice chair and chief global economist. He was speaking to me in his personal capacity and before he joined PGIM. It's a real pleasure for me to interview Daleep, who I have worked with in and out of government since 2014, when he was at the Treasury Department and I was at the State Department, and we were both working to impose sanctions on Russia, something that we'll talk about a bit after we have our discussion of the Sovereign Wealth Fund. Plus, I think you're just going to like this interview. Daleep Singh, welcome to the Security Economics Podcast.
Great to be with you, Peter.
It's a real treat for me to have you on, Daleep, because you and I have had the opportunity to work together at different points over the years. And in particular, it was such a pleasure for me to work with you when we were both at the White House in 2021 and 2022. And there's so many topics that I want to cover with you today, and I really appreciate you taking the time. But the topic I'd really like to start talking with you about today is a concept that's getting more and more attention from U.S. policymakers as well as from the media, which is this idea that the U.S. should establish a sovereign wealth fund. In February of this year, President Trump issued an executive order with a report that's due in just a couple of weeks with recommendations on whether and how the U.S. should establish a sovereign wealth fund. And the report, so there's a former Morgan Stanley banker maybe being tapped in order to set up that sovereign wealth fund here in the United States. Now, but before we turn to the pros and cons of a U.S. sovereign wealth fund and what a U.S. sovereign wealth fund might actually do, I want to step back and ask you just to explain what is a sovereign wealth fund and what are countries doing when they set these things up?
Sure. Again, wonderful to be talking to you, Peter. We made a great team. Look, I think the first sovereign wealth fund was set up in 1953 by Kuwait. And for about half a century, sovereign wealth funds were created by countries that generated a lot of surplus income each year and decided to invest their income stream into a portfolio of assets that diversified and grew their national wealth. That was the idea. So think of countries in the Persian Gulf or Norway or Chile. These are all countries that generate large and sustained trade surpluses from exporting natural resources. And the income they earn from selling those resources, it fluctuates with a price that's set in the global market. And that means the income stream is volatile. It also means the income stream is uncertain. There may come a day when global demand for these natural resources fades away. For these countries, sovereign wealth funds provide a form of insurance. They reduce risk by allowing countries to invest their income in a portfolio of assets that can sustain their wealth. That was the idea. Now, East Asia is somewhat different, but there's still a shared logic. Most of them are not net exporters of natural resources, but many do generate large trade surpluses from selling manufactured goods to the rest of the world. So think of China. By itself, it accounts for almost a third of global manufacturing production in value-added terms. So that's more than the US, Japan, and Germany combined. It's really big. So when China sells iPhones or solar panels or toys or furniture, its exporters mostly get paid in dollars, since dollars are still the dominant currency for invoicing trade. And then China's exporters sell those dollars to China's central bank in order to receive local currency to pay their expenses. All right, so in the 2000s, China's central bank was amassing a huge pile of foreign reserves, mostly dollars, both from trade surpluses, but also from intervening in foreign exchange markets to accumulate even more dollars and sell their local currency to suppress the value of the renminbi and to turbocharge its export-led growth strategy. So the question for China on the eve of the financial crisis in 2007 was, what should we do with this pile of dollars? And at that point, they had a stockpile of almost $2 trillion on the way to 3. And so China decided to take a portion of that stockpile, about a tenth, I think, and set up the sovereign wealth fund, the China Investment Corporation. And on paper, the purpose was fairly standard: make money by investing overseas more actively and profitably than it could just by parking dollars in US treasuries. But in reality, as Peter, the CIC became a linchpin of China's grand strategy. So since 2007, it's acquired choke points in energy supply chains across Africa, Latin America, and Central Asia. It's bought stakes in critical infrastructure across the world. So think of ports or underwater cables or railways or cell phone towers. It's stroked checks across the developing world and become a financing superpower to Belt Road signatories. And it's taken stakes and funded prestigious Western financial institutions and set up co-investment vehicles with other countries. That's a different proposition than what Kuwait set up in 1953. And I'll say today, the CIC is not an outlier. We did our work on this when I was in the US government, and our estimate is that about a third of the $12 trillion in assets under management by sovereign wealth funds are now being used to maximize strategic value for their countries, as opposed to maximizing profits.
So you've really seen a shift from a kind of purely return on investment approach. We have a resource that's declining over time, like oil. We need to have some assets that we can invest over time to eventually make returns, to a more of a strategic investment approach. That's been a sort of last 10, 15 years shift.
Yeah, and it's not a coincidence. The world has changed. Geopolitical competition has evolved, and so have the institutions for competition. And if anything, we are now the outlier for one.
I'd be remiss when you mentioned the different countries that have sovereign wealth funds if I didn't make what I think of as Brad Setzer point, that Ireland may have a natural resource of tax revenues from American firms that it is using to set up a sovereign wealth fund. Before I ask you more about what the U.S. might do here, you talked about China and what China is doing with its sovereign wealth fund. What is a model for a potential U.S. sovereign wealth fund that you might see as a positive model? Would we be looking at Singapore? Would we be looking at Norway?
To me, the right template is Temasek. But let me explain why.
That's Singapore's sovereign
yes,
fund.
And they have multiple vehicles. The GIC is the more traditional vehicle to maximize risk-adjusted returns. Temasek is more focused on maximizing strategic value. But the argument for Temasek, the argument I think that would make sense to me for the U.S., it's twofold. There's a national security argument, and it goes something like this. Number one, let's just stipulate we're living in the most intense period of geopolitical competition since at least the end of the Cold War. Number two, our strategic rivals, namely China, but also Russia, have expressed and revealed a shared desire to disrupt and upend the US-led order. Three, since most of today's great powers are nuclear powers, barring catastrophic miscalculation, the logic of mutually assured destruction suggests that competition with these countries is mostly going to play out in the theater of economics, energy, and technology, rather than kinetically on the battlefield. Four, and here's the punchline: America, we have unrivaled economic firepower. No one would doubt that. But we're only going to prevail in this competition if we can harness our economic firepower to our strategic advantage. And left entirely to itself, the private sector's incentives are not designed to fight this battle. They're designed to maximize profits, typically under very short time horizons, not to maximize our long-term strategic advantage. I hope that's an obvious point. There are obvious reasons why venture capitalists tend not to make large upfront capital investments in physical assets that require a decade plus to generate commercially attractive returns. especially those with really complex and opaque risks. Why? Because they have better alternatives. Early stage investors can scale business models in apps or software or services, often within 3 to 5 years, and exit with really healthy multiples. That's not typically the case for projects that have a real nexus with our economic and national security. So you've got this valley of death that people talk about between basic research and commercial scale for hardware projects that are potentially game-changing for our country. And so think of technology moonshots like nuclear fusion or solid-state batteries or next-generation lithography or neuromorphic computing. You can even think of old economy sectors in which we have a competitive disadvantage, like shipbuilding. And I know you had a podcast on this, which I thought was excellent, or minerals processing, or lagging edge semiconductors, where the strategic rival actually has the choke point. The PRC in particular, they've ramped up public funding for years with an eye towards commercial dominance for geopolitical gain in these areas. U.S. funding, both from the public sector and the private sector, we've lagged very substantially. So that's the national security argument, is that a sovereign wealth fund could get us back in the game. They could provide a pool of patient, flexible capital that bridges over this valley of death between basic research and commercial scale. And ideally, it would be designed in a way that motivates the private sector to follow on these investments at pace and scale, because that's really our true competitive advantage. And it was the story of the post-Sputnik era. And the point is, let's recapture that spirit. There's another argument, Peter, that's Finance 101, but I'll come to that if you'd like.
Let me come to the Finance 101 argument in a moment. I think you made a really interesting case that you see two potential buckets of investment. One is a kind of technology moonshot bucket of investment where, for various reasons, private capital isn't willing to invest over a long enough term time horizon to make the kinds of investments that we need. And the other being some of these old economy sectors where, frankly, we're losing to China and other countries, for example, shipbuilding. How do you think about a sovereign wealth fund specifically identifying what sectors it should focus on? What's a methodology that you would think the sovereign wealth fund should be using to decide, here's the kinds of sectors or products or technologies that we're going to be investing in?
The U.S. government has spent a lot of time in various pockets of government trying to identify what are the critical and emerging technologies that have the most significant consequences for our economic and national security. And I think that exercise needs to be done very closely with the private sector. We've got to be really humble. When you're in government, you're always going to be behind the frontiers of technology. And you're always going to have failures of imagination in terms of which applications of that technology are going to be most relevant for your economic growth potential or your national security. So I think you want to make a large number of bets and expect that most of them are not going to play out. But look, if you are a believer that over the next, let's just say 5 years, we're going to have AGI and a quantum computer and nuclear fusion, then you should train your mind on what kinds of investments are going to best position us to capitalize in that kind of world, because it's a completely different world than the one we have now. Free compute, unlimited energy with the potential to solve computational problems that would take thousands of years for a classical computer. Our only constraint is our imagination, and we shouldn't do that alone. So I can't give you a precise list, and no one can. That's the whole point.
Well, let me come back to the Finance 101 reason you think
Yes.
the sovereign wealth fund.
This is the one that I come from this world in terms of my professional background. And let me put it this way, Peter, just because I have a relatively low income compared to my fancy neighbors, or just because I've taken on a big mortgage to buy my home, that doesn't mean I shouldn't have a 401k. In fact, it's even more reason to have a 401k that optimizes the value of my assets and helps me pay for my kids' education, my retirement, the maintenance of my house, a rainy day fund, maybe financing a neighborhood watch, the school's basketball uniforms, the ability to help a neighbor in need. Right? Now, I need to be careful because I don't have much margin for error if I have a low income and I have a lot of leverage on my public balance sheet. I'm spending beyond my means. That's the story where we are right now. But if I'm sitting on a bunch of dead assets, for example, sitting in my attic, Think of baseball cards, or I've got a collectible car that's just gathering dust in my garage. How can I bring those assets to life? Or if I'm spending a lot of my income on fast food that doesn't help me in the long run, maybe I should spend that money instead on a gym membership that sustains my long run health. So that's the point is, are we prioritizing the value of our existing asset base and our existing income stream in a way that makes us, the American people, better off over the long run? I think the answer is no, we're not optimizing our balance sheet in that way. That's Finance 101.
Let me ask you a follow-up question on that, Daleep, because I think one of the questions that will always come up in a U.S. context when we talk about a sovereign wealth fund is where should the funding for it come from? As you said in your earlier remarks, the original concept of a sovereign wealth fund was being driven by export-oriented economies, usually natural resource exporters, that had a very clear revenue stream that was coming in that was creating a surplus over immediate spending needs within the country, and they could use this as a vehicle to save that money for the future. Obviously, U.S. currently running a fiscal deficit that seems almost certain to remain true for the foreseeable future. Although we do have substantial natural resources, they tend not to be government controlled. The U.S. government can't really sell the oil and pocket the money. It's Exxon and Chevron that sell the oil and return the money to their shareholders. Where do you think the funding should come from for a sovereign wealth fund from a U.S. perspective?
We thought about a few ideas, and I'll give you the one that I prefer. So one possibility is we can, as I just mentioned, optimize the asset side of our balance sheet. So I don't think anybody would question that the United States is asset rich. The federal government owns about 30% of the land in this country. We have extensive energy and mineral rights. The government owns the electromagnetic spectrum, which is then leased for the purpose of telecom. We have extensive infrastructure assets that actually aren't working especially well. Airports, ports, highways, energy grids. We have an extensive collection of financial assets, 8,000 tons of gold valued at 1934 prices. That's about 50 times lower than prevailing market prices. Treasury will hate me for saying this, but we also have over $200 billion in mostly money market assets in the Exchange Stabilization Fund. 170 billion or so of which are in special drawing rights, which we don't need and we really can't use. So the first question is, can we maximize the strategic bang for buck on our asset side, on the asset side of our balance sheet? And I would say right now we're not doing a particularly good job of that. So that's one potential source of funding.
So even before we get into borrowing or appropriated money, you just say optimize the resources that are currently, in some sense, on the federal government's balance sheet.
Debt asset, bring it to life with a more productive one.
Okay.
That would be the idea. The second is, can you create new revenue streams that help fund the vehicle? So for example, if we agree on a bipartisan basis, ideally, that the U.S. economy has too much Wall Street, not enough Main Street. In other words, that we have an overly financialized economy that's led to boom-bust asset cycles to the detriment of the real economy, then let's do something about it. Let's raise revenues from financial activities that serve no strategic purpose. And for my money, high-frequency trading is one of those activities. Maybe it's carried interest. And use those revenues to fund a vehicle that's expressly designed to advance our strategic interests. That has a certain amount of elegance to it. Then there's another idea, which is basically wall off a portion of the fund once you have some seed capital. And during the startup phase, basically tell it to act like a hedge fund. So maximize returns subject to some acceptable risk threshold and a liquidity threshold, and use the profits to fund the strategic vehicle until you've reached target size. But look, my strongest preference, Peter, is the most simple one and the most transparent approach, which is ask Congress. Ask Congress to seed the fund, to authorize its existence as an independent, federally chartered corporation. No gimmicks. It's too important of a national project to leave this entirely to the executive branch. And so the right way, I think, is to seed the fund with a one-time appropriation from Congress. I would say something on the order of $50 billion. Ask Congress, work with Congress to lay out a clear legal mandate that defines the fund's strategic objectives. Where should it invest? Our notional idea was pick three North Stars: boost supply chain resilience, sustain technological preeminence, safeguard energy security. Now, we should have a discussion about whether those are the appropriate objectives. Should they change over time? That's completely fine. But Congress could lay that out, lay out metrics for success, oversight, and democratic accountability.
Let me ask you a question about governance issues, because you brought up governance issues there. And I thought you had a very nice way of laying out how you think Congress could give the Sovereign Wealth Fund a mandate to think about its sectors or strategic priorities it would want to invest in. But I also think if we're talking about setting up a sovereign wealth fund here in the U.S., there are going to be questions about how this thing should be governed. Should it be a kind of quasi-independent agency with an independent management board? Should it have a couple of cabinet secretaries serving on the management board? You can picture different models here. I'm interested in how you think about the governance issues and how the board or other governance structure should be structured.
This is the biggest risk, governance, by far. There's a real danger. We should all admit this. Those of us who are thinking about this idea, there's a real danger for this vehicle to become a political piggy. That's not a partisan comment. There's a real risk that it becomes a vehicle to serve special interests, well-placed individuals, and ultimately is a national embarrassment. The key design question is, how do you strike the right balance between insulating the fund enough from political interests and corrupting influences, while at the same time maintaining democratic accountability? That's the key design question. I think the right template is the Fed, or if you want to go back in time, the Reconstruction Finance Corporation, which, as you mentioned in your question, independent, federally chartered corporation. And the RFC, that financed the buildup of our industrial capacity for 2 decades after the Great Depression, played a decisive role in our becoming the arsenal of democracy that helped to win the Second World War. I think there's a certain appeal to using that as a template. And if you do, what you would do is first, as I mentioned, ask Congress to establish an independent, federally chartered corporation wholly owned by the U.S. government. Congress would establish the legal mandate with strategic objectives. Congress would lay down risk limits and prohibited uses, for example, taking controlling shares in a particular company. And it would require audited financials, annual reports. I think semi-annual testimony would be appropriate, much the Fed must give. And then you'd have an independent board with members, I would say, appointed by the president, approved by Congress, with terms that are staggered across the presidential political cycle. And the board would then appoint a technocratic executive director who would then recruit and hire a world-class professional staff with protections to protect against political capture. So the point is, we can think of all sorts of other guardrails. We should be humbled by the risks that are involved, not paralyzed, because we've done this before. And we've done this before when the world changed, and here it's changing again. And we've adapted and reimagined our institutional setup to compete in the past. We need to do so now. We may need to course correct along the way. I think some degree of trial and error and experimentation should be expected. We're not going to get it right in the first instance. But I think, Peter, the point I'm making, the greater danger in this moment is to do nothing and to let inertia, institutional inertia, be our guide and not take enough risk. That would be the bigger mistake.
One final question for you on sovereign wealth fund issues. Over the last, not just couple of years, but over the last decade or two, there has been a growth in U.S. government offices that are involved in what you might think more broadly as strategic investment. So we had the creation during the first Trump administration of the Development Finance Corporation to make strategic investments of different kinds, mostly on the lending side, not on the equity side, overseas, building on something called OPIC that was more of a global political risk insurance program, but the DFC being a kind of international strategic investment fund. We have the Exim Bank, which has historically been used to finance U.S. exports. Over the last couple of years has gotten into the, again, on the debt side, not the equity side, but providing financing for manufacturing investments here in the United States where that might help promote U.S. exports. And then we have things like the Department of Energy's Loan Program Office to try to make investments in energy production and manufacturing here in the U.S., and the Defense Department in addition to In-Q-Tel, which everyone has heard of as like the CIA's kind of tech startup VC fund out in California, the Defense Department also has a new Office of Strategic Capital to try to make investment in defense technology companies. How would you situate a sovereign wealth fund alongside these other strategic investment vehicles that the U.S. government has developed over the last some years?
You're right to lay out the status quo. We have an alphabet soup of existing agencies with existing financing authorities. Look, I'm less concerned about form than function. If among this patchwork of existing agencies, if we had a pool of patient capital with the explicit and exclusive purpose to advance a set of strategic objectives that the private sector left to itself will not finance at pace and scale, then I would just say let's embrace and strengthen those agencies. But I think we have gaps in that patchwork. So you mentioned a few, Peter. By legal mandate, the Development Finance Corporation, which is really our flagship overseas investment vehicle authorized by Congress, it cannot provide financing to most upper middle income or high income countries. And almost 3/4 of the countries in Latin America and the Indo-Pacific are currently above that income threshold. And then if you mention EXIM, the U.S. Export-Import Bank, and really I'd throw in the Trade and Development Agency, TDA, they're both restricted to promoting U.S. exports without explicit regard for strategic value. You mentioned DARPA. That can only focus on early stage R&D, not developing commercial scale for those innovations. And you mentioned the Department of Energy's LPO, the Loan Program Office. Here again, this office is restricted to debt and loan guarantees for clean energy deployment. So look, we've got a choice. Either we can fill the gaps by broadening the authorities of our existing agencies so that they have an explicit strategic mandate, or we can create a new flagship authority that can invest at pace, at scale, at home or abroad, across the capital structure, not just loans, not just debt, but also equity, either alone or with the private sector. And I care less about where these authorities reside, much more on whether they exist. That's, to me, what matters.
I was going to end the sovereign wealth fund question set there, but let me ask you one more. What kinds of investments do you think it should be authorized to make? Would this principally be an equity-focused sovereign wealth fund? Would it be debt and equity? Would it fit alongside private investors in its different investments? Where do you see it fitting in a capital stack?
So if you buy the structure I'm sketching out of a barbell, so you've got investments in early stage technology moonshots that could be game changing for economic or national security. Here we're really talking about equity investments. And you don't need a very large quantum of money to deploy. You just need to have the ability to take really serious risks along the lines of what a venture capital investor would do. But then for the more mature old economy sectors, and I mentioned shipbuilding or minerals processing or lagging edge semiconductors, really commoditized markets that are low margin, here you really should think about non-equity stakes as well. They may need some later stage debt financing, some mezzanine financing. They need a different type of financing because they're not proving the concept that they're trying to scale as fast as possible. That to me lends itself more towards debt investments. That's why I say you need authorities across the capital structure.
That makes a lot of sense. If you actually want to get strategic investments stood up, where the sovereign wealth fund would invest is going to depend on what that specific investment is and what is the kind of capital it needs. Daleep, I want to change direction because while I mostly wanted to interview you today on the sovereign wealth fund, I also want to take advantage of the time we have together to ask you about a couple of other topics that you both have worked on during your stints in government and also that you have thought about during your time in the private sector and across the course of your career. And the first of these is sanctions, which is something you and I have worked on together as well as separately since I first met you back in 2014 when you were at the Treasury Department. I was at the State Department. We were both working on assigned to deal with Russia sanctions after Russia's first invasion of Ukraine, taking over Crimea back then. And then, yes, here we are. Exactly. Yes, some things, Russia doesn't change, unfortunately. That is a lesson of history here.
Russian history, yes.
Going back to the Obama administration, when you were at the Treasury Department, Looking at the last 10 or so years where you've been working on sanctions issues, what are a couple of the key lessons you take away from that experience?
Oh, goodness. We could spend, how long are your podcasts, Pete? Okay, I'll try to summarize what I would say there. Okay, lesson one, and I've repeated this since I've been in the sanctions business since 2014, as you said. The best sanctions are those that never get used. Sanctions by a major economic power are a blunt instrument. Negative spillovers and unintended consequences are unavoidable, including second and third order effects that are really quite serious. For example, that could erode the primacy of the dollar. I remember sitting at the New York Fed on March 23rd. I remember this date very well, March 23rd, 2020. And I remember the transformative effect that we had simply by publishing term sheets for emergency credit facilities that left no doubt to the median market participant that we had a bazooka to backstop the real economy. And from that point on, in the COVID crisis, no one dared fight the Fed. And we avoided needless bankruptcies by solvent businesses and backstop the economy in a very significant way for households. So there's an opportunity to do the same thing with the signaling of sanctions to shape geopolitical outcomes by deterring rogue actors. And you remember, we tried to do this before Putin's invasion in February of 2022. As a self-critique, we were not specific enough, in part because we feared Putin might have front-run the freezing of his central bank assets before we did. And also because it took kind of the hellscape of war, the sights and sounds, to convince the G7 to fire our bazooka. So there's a reason why we couldn't be more specific. But this is an area that's ripe for further design improvements and also execution. Lesson two for me, and this is a corollary of the first one, is that if we're sanctions signaling to have credibility, to have punch, the threat needs to be real. And the truth is that foreign adversaries, especially Russia, they regard the United States and Europe as having a low tolerance for economic pain, for the spillovers of sanctions to our own economy. And it's not because they're delusional. It's because that's been our track record. We tend to blink. And sometimes we have to be willing to go all in to impose and to sustain overwhelming economic force to avoid an even worse geopolitical outcome. And in the case of the Russia sanctions, we did max out on financial sanctions. And I believe we did come close to maxing out on export controls. But we did not max out on Iran-style secondary sanctions on energy. Maybe we could have done so if we coupled it with an all-of-government effort, including from the Fed, including from fiscal authorities and regulators, to cushion the blowback. Maybe. That's something that I lose sleep over. But even if that had been our proposal, it's totally unclear and probably implausible that it would have gotten through. That's the reality.
I think you raise a really interesting and important point there, Daleep, which is if I look at the sort of history of the last at least 20, 25 years of American sanctions, like post 9/11 era of American sanctions, Iran, Russia, Venezuela, North Korea, we have clearly shown that we can inflict pain on our adversaries. We've clearly shown that we are creative in developing ways to inflict pain on our adversaries, understanding global financial and payment channels and figuring out how we can weaponize them. And I think there is a high degree of credibility from our adversaries' perspective that they will face sanctions. But I very much agree with the point you just made, which is that we here in the United States have also shown that we aren't really willing to bear significant costs ourselves as a part of these sanctions campaigns. So I do worry we have sent this message that while we are creative and willing to inflict pain, there are going to be upper limits to the pain we are willing to inflict because we aren't willing to bear pain ourselves. And I worry about the message there that we have sent when we think about big power adversaries over the last couple of years.
And look, I think it's completely rational to apply pressure where we have asymmetric advantage, where we produce something that the target needs and can't easily supply from domestic sources or from a third country. That's why we chose to max out on financial sanctions and export controls, because we have an asymmetric advantage in the primacy of the dollar, the centrality of our capital markets, as well as cutting-edge technology. We did not have an asymmetric advantage as it relates to energy. And so the risks We're two-sided, and we didn't max out as a consequence. So either we need to develop even more asymmetric advantages, or we need to accept symmetric costs and anticipate them, cushion them, deal with them. That requires leadership, and that requires conditioning the public for what's to come. If you'll let me go on, Peter, there are a couple
please.
Please. There's a
Please.
lot. We've been through this for the past decade plus, so there's a lot to say. The third for me is, and this may actually sound like it contradicts lesson 2, I do think we need to articulate limiting principles on sanctions and a doctrine for the use of economic statecraft at the highest levels of government. And why? Because we want to keep countries bought into the dollar-based financial system, which is the operating system of the global economy. And that's the only way we're going to sustain the potency of sanctions, is if countries stay bought in. Otherwise, countries will continue to hedge, and eventually there will be a parallel or competing financial architecture. I think we do need to demonstrate our willingness to impose overwhelming economic force. We also need to lay down rules of engagement that limit overreach, that say we're going to use these tools sparingly and only in defense of shared principles that underpin global peace and security. They need to be sustainable. They should be coordinated. They should be flexible. And that's what I'm describing as an economic Geneva Convention, a global agreement that sets out why, how, when, and to what extent these tools should get used, not just for sanctions, but also for export controls and tariffs, not just for us, but ideally also for our allies and, yes, our adversaries, because otherwise we're going to have a fracturing of the global economy that leaves us worse off. Lesson 4 for me is, if we're going to do all of these things that I'm discussing, we need an analytical infrastructure and an organizational design that's fit for purpose. We do need to take regular inventory of the restrictive tools at our disposal. We need to make sure that we still have operational readiness to use these tools. We need to assess their historical efficacy, study the historical spillovers, stress test and war game how they'll do against imagined scenarios, assess where do our strengths intersect with our targets' vulnerabilities, and vice versa, anticipate where evasion is going to occur, and build readiness for countermeasures in real time. Invest in understanding the reaction function of autocratic leaders to economic pain. Test the resilience of critical supply chains so that we have early warning signals on emerging choke points. All of this is meant to inform a conversation about where the United States needs to invent or reimagine new tools, new defense mechanisms, new forms of coordination so that we can prevail in an extended conflict with an even bigger adversary than Russia. That's the point. And then on organizational design, we should take a page from Japan. They have set up a Department of Economic Security. I think we should do the same so we can have strategic coherence in the use of our restrictive tools, and so that we can also recruit multidisciplinary expertise across macroeconomics, trade, financial markets, cutting-edge technology, economic diplomacy, and the law still matters. So look, you need to have the scale and scope and absorption capacity in this department to handle multiple crises at once. And you need to have connective tissue to regulators, to the private sector, to allies and partners so that we can execute at pace in a crucible moment. Like, I don't think we are set up for that right now. The last point I'll make, and then I'll shut up because I know I'm going on a bit. I think no matter how compelling our limiting principles are, or how beautiful our doctrine reads, or how robust our analysis becomes, ultimately sanctions break bonds in the global economy. They're never going to win hearts and minds. So we need balance in how we use economic tools to promote geopolitical objectives. And that means I think we should convey a standing preference to use our marginal unit of time and energy and focus, not on sharpening tools that inflict economic pain, but on tools like a sovereign wealth fund. If we're going to change the narrative, we need to actually have better balance. And our most potent tools are not sanctions. They're the positive ones. So I guess this conversation comes back to where we started.
Daleep, I welcome you going on this topic. I think it's really interesting. And I share your view. I have a historical view that from kind of 1960s through the 1990s, the U.S. spent a lot of our economic geopolitical energy on the inducement and economic tie building side of the ledger, right? We had several rounds of GATT trade negotiations. We did bilateral FTAs. We set up the WTO. Kennedy set up USAID on the development assistance front. And we really succeeded in building a globally integrated international economic order. And then on the post 9/11 era, we have spent a lot of our energy on the coercive side of the ledger. We've thought about in great detail, how do we weaponize the different choke points that we have created, economic choke points we have created around the world. But we, in some sense, with a few exceptions like the creation of the DFC 7 or 8 years ago now, we've forgotten and lost momentum on the connectivity building side. And in order for the economic order to work for our interests, we need to be working on both those tracks at the same time. We need to both be building connectivity as we think about how to use these coercive levers where needed to achieve our goals. And to me, a sovereign wealth fund could certainly be a large part of that. I know we're coming up towards the end of our time. I do have one more sanctions question for you, just because it seems topical. President Trump has expressed some skepticism of sanctions, both going back to his campaign and then more recently where he's talked about overuse of sanctions. And a couple of weeks ago, he hit on this idea of secondary tariffs, which I feel like is something, we should have seen coming, Daleep, because of course, President Trump is going to think about tariffs as his geopolitical tool of choice. But this kind of idea that rather than sanctioning the Chinese for buying Venezuelan oil, we will simply pile additional tariffs on China in order to dissuade China from buying Venezuelan oil. I'd be interested in your thoughts on this kind of secondary tariff concept. Do you think this is something that is going to get some legs that people will actually be thinking about and using over time? Or do you think this is going to be one of these ideas that Trump may have and that will then fade from the policy toolkit?
My view, Peter, is you need to be careful about using one tool for multiple objectives. I think it's really hard for any instrument, whether it's tariffs or could be another restrictive tool, to simultaneously raise revenues, reshore manufacturing, punish bad actors, create negotiating leverage, set the stage for imperial acquisitions, et cetera, et cetera. It's really hard, right? Especially when, look, the way I think of tariffs is from where do tariffs derive their potency? It's our position in the global trading system. And global trade is truly multipolar. We're 25% of global GDP. Our share of global trade has fallen steadily. I think it's back towards around 10, maybe 15%. We're below China and the EU. So we're not really a trade superpower in the way that we once were. We're a superpower in terms of global finance. So the dollar's share in terms of saving money or buying or selling things or raising money, those are the three kind of measures that you use to establish whether reserve currency is dominant. Our market share is somewhere on the order of 40 to 60%. Let's call it double our share of the global economy. Well, that's what makes sanctions quite potent. Now, I'm not saying we shouldn't have limiting principles on sanctions, quite the contrary. I agree with the president that we should avoid overreach on sanctions. But we should do the same with tariffs, especially since we don't have an asymmetric advantage using them. So that's why I think they're strategic flaws in terms of the understanding of where our economic power is derived. And that's going to take us to a bad place because we don't have the leverage that he thinks.
That's a really thoughtful point. We think of trade as one of our sources of leverage. It's actually not as relatively large a source of leverage as some of our others, like the role of the dollar in
or export
payments.
Controls that derive their power from our dominant position in frontier technology. Now, that's a potent tool, and China knows it.
Yeah.
So I think this is playing into Beijing's hands.
It's a really interesting point. Okay, you've been very generous, Daleep, with your time. I do want to ask you a last question, particularly given that after a very successful second stint in the White House, you are heading back to PGIM, the global asset manager. And I assume in that role, you're going to be thinking less as a policymaker and more about how, as an investor, how the world works and the trends we are likely to see over the next couple of years. I think it's safe to say that we are in a more geopolitically chaotic world than we were even a year or two ago, much less a decade ago. And that if you look at the sources of geopolitical risk today, the United States, we have to admit, is a source of geopolitical risk in a way that we wouldn't have thought of it 5 or 10 years ago. What are the geopolitical developments, though, that you think investors and companies are not paying enough attention to and that might surprise the private sector over the next year or two?
Oh, Peter, I'm going to struggle with this one because I have to admit, I don't know what companies and investors are paying attention to at the moment. I've been taking time to
get back into it quick, Daleep. Your colleagues in PGIM are going to be saying, what's happening? What's happening?
Ask me on at April 21. That's my start date. But no, let me answer it this way. I do think PhDs are going to be written on the taxonomy of geopolitical risks that tend to matter most for financial markets. In my experience, and I'm trying to formalize this actually, they tend to be risks that the market has not seen in recent memory and therefore hasn't modeled or hedged, number one. Number two, these are risks, geopolitical risks that have immediate, quantifiable, and nonlinear effects on the real economy. Okay, so that's two. Three, they have to involve major economic powers, not the periphery. And four, they don't have an obvious policy response to neutralize the effects of the geopolitical risk or shock. Okay, so that knocks out a lot, actually, that I think most people would intuitively think should matter for markets. Actually, I think the tariff mayhem, my suspicion is that's all anybody's been thinking about or talking about for months now. You tell me. The erosion of the rule of law, not easy to quantify. The assault on our institutions, the destruction of our alliances, the unraveling of the international order we built over the past 5 years, even the looming fiscal day of reckoning. These are all risks that, my gosh, they matter deeply. Almost any one of these are existential for our country. But I wouldn't hold your breath on markets anticipating the endgame from these risks with an outsized or sustained response ex ante. They'll want to see it.
Thank you very much. I think I'll leave it there. I don't want to get any darker as a way of ending the podcast, but I do think that's a really sobering but also thoughtful way of thinking about the risks we are not thinking about. Daleep Singh, thank you so much for joining us today.
Thanks, Peter.